As traders, before things like position sizing and trading psychology, the number one aspect of trading that we have to get right is a profitable strategy or a profitable method. And if you've watched many of my YouTube videos before, you'll know that I often share my ideas for strategies to encourage you to create some profitable strategies of your own. In a previous video, I stole, or maybe borrowed, a strategy idea from algo trader Kevin Davey, and it was a strategy he used for crude oil. But I thought I'd take that strategy idea and see if I could get it working on the Forex markets. And you might have already seen, I did, and I got it working on Australian dollar versus the US dollar. And in this video today, I take that similar strategy for Australian dollar and modify it even further to change the characteristics of the strategy. So this time it takes more trades and it has a higher winning percentage. So I'm going to show you how and why I changed the rules, show you the development process along the way, and then I'm going to show you how the results differ to the previous strategy before I made the extra modifications. But before we start to look at the strategy and the rules, a quick word about how I normally show you the development process on these videos. To keep the videos generally as short as possible, I show you one approach that I use to create the strategies, and that involves taking a wide range of data, normally 10, 12, 13 years of data at the moment, because I have data back to 2008 for foreign exchange, and I use about 80% of that data, and then I'll do my strategy testing, developing, modifying, and then once I'm happy with the results, I'll take the remaining 20% of that data, which is always the most recent data, and then I'll test the strategy on that most recent data to see how it performs. And then if the strategy continues to perform like it did on the original data set or the in-sample data set, then I move on to the next process. And that doesn't mean trading straight away. You'll often hear I don't say trade these strategies straight away. I then watch them for another few months at least to make sure that they're performing just as well in true, unseen future data. The strategy and the modifications to it that I'm going to show you today didn't actually work out that well in the out of sample data, but I'm going to show you that anyway because I think that could be quite valuable for you to have a look at. But additionally to that, I'm going to show you some more developments that I used using a more in-depth process that I often use but rarely show actually on video, using walk-forward analysis. And the results from the walk-forward analysis on this strategy were actually pretty good. And generally, results from the walk-forward analysis I find are more representative of the future data anyway, unseen performance. So firstly, we'll see the regular development using the in-sample and the out-of-sample data, and then I'll show you the more in-depth strategy using the walk-forward analysis. And because I wasn't happy with that first initial testing using a basic method, I'm going to use the results from the walk-forward analysis version to compare to the previous video showing the previous strategy to show you how we've made small changes in the strategy and how it's changed the characteristics of how the strategy trades. So let's go and have a look at the strategy, do the comparison, and then you can decide from the results which one you think you'd prefer to trade. Firstly, let me briefly explain the strategy rules. We're pretty much buying pullbacks in a longer term uptrend, and we're doing the opposite for short trades. So we're selling short rallies in a longer term downtrend. To identify the longer term uptrend for buying trades, essentially we're looking at daily bars, and we want to see that the daily close is higher than the close of the bar 40 bars ago. But we also need to see that daily close lower than it was 10 bars ago. So we're looking at a longer term uptrend and then a slight pullback in that longer term uptrend, and opposite for short trades. Now, 40 and 10, I don't know if they're going to be the best look back period, but we're going to test that. However, part of the rule that I borrowed from Kevin Davey says that the shorter term length, so in this case the 10, is always 1/4 of the longer term. So in this case we're using 40 and 10, but we could be using 24 and then a quarter, as it will be 6, so 24 and 6 for the shorter term. But we're going to test those numbers. We're going to be using a fixed pip stop loss, and we're going to test which works the best. And the previous strategy actually used a profit target, and I'm going to scrap the profit target. I don't particularly like profit targets, so we're not going to be using a profit target. But what we are going to be using is a bailout exit or a first profitable close. And that's also going to include a day delay. So what that means is if our day delay was 0, then as soon as the daily bar closes, when we're in a trade, we look to see if we're in profit. If we're in profit, we're going to take the profit and exit the trade, then wait for the next one to come along. But if we're not in profit, we're going to stay in the trade. Now, with that daily bar delay, we could have a daily delay of 5. So that means we have to be in the trade for at least 5 days before we then look for, are we in profit or not in profit? And if we're not in profit, then we stay in the trade and we check back the next day and so on until we either are in profit and exit, or we get stopped out, or we might even have an entry to a trade in the opposite direction. But we're going to test that day delay number. All the developments, this one and the more complicated walk forward analysis development, are all testing one full lot of Forex, and they're all including trading costs. We're actually including $50 of trading costs per round trip. This first test is going to be using in-sample data from 2008 to the end of 2018, and then the out-of-sample is going to be 2019, 20, and then 2021 up until September, which is when I'm recording the video today. Let's have a look at the first development. I'm going to run through these developments as fast as possible. So in this first development, we're looking at obviously Australian dollar, US dollar, and we're looking at a 1440 minute or a daily chart. Now, in the first strategy, I've got no stop loss and I'm not using that first profitable close exit. So what you'll notice is that we're always in the market now. So if we get a short trade, we enter short, and then the only way we're going to exit a short is if we've got an entry to go long, and vice versa. First thing I want to test is that look back period. So let's have a look at the results. And I've tested from 20 bars right the way through to 52 bars. And if you've seen the previous video, you'll know why these are going up in steps of 4. And the reason they're going up in steps of 4 is because I mentioned that the shorter term look back is always going to be 1/4 of the longer term look back. Otherwise, Multicharts does just round things up, but I'm going to keep them numbers divisible by 4. So looking down at the numbers, if we check the net profit, the highest is here at $65,000 net profit, and we've got a look back period of 28. So that would be, the longer term would be 28 and the shorter term would be 1/4 of that, or 7. However, I don't think it's the most stable. I actually prefer using 32 because we've got 65, 56 either side of it. So in this case, I'm going to actually choose 32 for the look back period. And if we look at the equity curve, and that's what the equity curve looks like. It looks pretty nice, so I'm happy with that. Let's move on to the next workspace. And in this one, we're going to optimize that day delay on the first profitable close or the bailout exit. And I've optimized from 0, so we're not using any delay whatsoever, right the way through to 15. Now, interestingly, I actually found some higher net profit numbers as we started to go longer, sort of 25, 30 bar delay. But that kind of defeats the whole object of the bailout exit. For me, the bailout exit is to get out as quick as possible. As soon as we got some profit, let's get out. So I actually limited it to only 15 days. And looking at the results, I actually looked through it and I preferred 12 as the day delay. So what that's saying is we need to be in the trade at least 12 days, and then after that, then we look at the close of every bar, and if we're in profit, let's take the profit. If we're not, we leave the trade open and check the next day. So let's use 12 and see how that has affected the equity curve. And the equity curve actually looks quite similar. We already know we're making 61,000, so that bailout exit has actually increased profit. We're making $400 per trade. So that's a huge average trade per trade. Remember, we've already got costs factored in, so most of this will be profit. We've got no stop loss at the moment. Notice our largest losing trade is actually $12,000. That's huge. That's a loss of about 1,200 pips on a single trade. So the next thing we need to do is look at a stop loss. I've optimized for stop loss between using no stop loss at all, right the way through to 600 pips. And I've actually found two choices amongst these results that I like. I like this area here, 250 pips. We've got a decent and stable net profit, and we're keeping the stop loss relatively small. However, I also like going larger, right up to about 450 pip stop loss, and this is extremely similar to the previous development. And just for now, I am actually going to use the 450 pip stop. Looking at the equity curve, we've still got a nice uptrending equity curve, so that's good. The next thing I want to do is to look at including that out of sample data. So in the next workspace, I'm going to include data from 2019, 2020, and up to September, or just into September 2021, to see how the strategy works. Let's use that 450 pip stop loss, and we use the look back of 32 and the 12 bar delay. And there you can see from the equity curve, this last green dot was the last new high in the equity. And if we hover over that area, we can see that that was around November 2018. So that was still within the in sample data. So everything to the right hand side of that is the out of sample most recent data, and you can see that it spent more than a few years not making new equity highs. So normally this strategy wouldn't pass my out of sample data testing, and I'd probably discard it or look at changing something quite major. Out of interest, let's just change the stop loss to that 250 pip stop to see if that makes it any better. Have to be a little bit wary because we're actually optimizing now using the out of sample data, which isn't always the best thing to be doing. But even using that 250 pip stop, the results look fairly similar. So overall, I'm just not happy with the out of sample performance with this data. So next we're going to look at the results or the strategy using the walk forward analysis. And the results are better. I could spend a long time talking all about the different approaches using walk forward analysis, but that's going to be for another future video, possibly. To keep things as brief as possible in this video, for the walk forward analysis, I've chosen to use 4 years of in-sample data and 1 year for the out-of-sample data. And this is the same approach that I used on the last strategy, which I used the walk forward analysis. So if you want to see more about the manual process, check out that video too. So the first 4 years of in-sample data, which is actually going to be from 2008 to the end of 2011, we're going to optimize each input for the best fitness function. That fitness function is often the best net profit number. However, I like to do things a little bit different with my walk forward analysis. I actually like to take the approach that I normally show you, like what we've just seen, using the most, what I call stable inputs, which is a little bit subjective, rather than using the net profit. But in this development, to test them back to back using the different fitness functions, I've used the net profit and then I've used the most stable input, and we're going to test both of them to see which one works the best. And I'm also using an unanchored approach, and again, more about that in the previous video if you're interested in the walk forward analysis procedure. We're going to be optimizing for 3 inputs. We're going to be optimizing for the look back, the day delay, and the stop loss, and we're going to be doing it in that order. So for the first 4 years, I'm first not going to use a stop loss or a day delay or the first profitable close, a bit like we've just done in the last development. And then I'm going to be optimizing for the look back period. Let's say the look back period, best one was 28. So then I'll select that, and still with no stop loss, then I'll optimize for the day delay. Find the best day delay, select that, then optimize for the stop loss. Apply those best inputs to the out of sample period, then move on to the next data set, apply that to the next out of sample period, etc., right up until the present data. So first of all, in this workspace, what I've got is data from the 1st of January 2012 right up until September 2021. Now the reason I've done that is because from the 1st of January, that is the first set of out of sample results we're getting from the walk forward analysis. Now, I've already done the walk forward analysis. I'm not going to go through that process with you. This video is going to be long enough as it is. So in this workspace, this is the 2012 through to present day using the results that we got from the first study. So we're not using the walk forward analysis. This is using just a fixed 32 bars for the look back, 12-day delay and the 450 pip stop loss. This is our comparison, and you'll recognise the part of the equity curve. Obviously we haven't got that early 4 years, but you'll recognise the later part and this out of sample period where the strategy wasn't producing new highs. In the next workspace, we're using the walk forward analysis. So everything you see, all the results that we're going to see, are using out of sample data from the previous 4-year period. And that's what the equity curve looks like. We have got quite a large drawdown here, but as we can see, we've got new highs right up until recently. So that's really quite pleasing. I told you the walk forward analysis actually looked better. Now the walk forward analysis in this study was done using the most stable inputs. Next, we're going to compare these results to the results of the walk forward analysis using net profit as the fitness function. But before we do that, if you're enjoying this video and you don't think it's been too long, then please give me a thumbs up and maybe subscribe to the channel if you want to see more videos just like this one. And this workspace is using the walk forward analysis with the net profit as the fitness function. And the results aren't quite as good. They're certainly not as good as using the most stable results in the walk forward analysis. And in this final workspace, you'll notice I've got 2 charts. The top one is the strategy from the last video that I've done, which is a similar strategy, but it uses a profit target and it doesn't use that first profitable close. The bottom one is what we've just seen, using the walk forward analysis and using the most stable inputs for the fitness function. So let's briefly compare the 2 results. Looking at the equity curve from the last strategy that you'll recognise if you saw the last video, and just reminding ourselves what the equity curve of this most recent strategy looks like. So today's strategy makes 26,000 in the out of sample. Last week's strategy makes 32,000, slightly more. Looking at the total trade analysis, last week's strategy only has 78 trades, has a large average trade of $418 and is 48% profitable. The average bars in trade look average in trade for 30 days. Let's compare that to today's strategy of 155 trades, higher percent profitable, 70%. Average trade is much lower but still acceptable, still pretty good at 170. And notice we're only in trades for 12.5 days on average. Looking at the drawdowns, we can see today's strategy, max drawdown was 11,400 and last week's strategy 11,500. So virtually no difference really. Let's just look at the time analysis and you'll notice that last week's strategy was in the market 95% of the time, whereas this week's strategy using that bailout exit is only in the market 72% of the time. Wrapping up this video then, I've got 3 main takeaway points. The faster in sample and out of sample approach that I normally show you didn't provide great out of sample results for this strategy. However, that's not to say that it won't begin making new highs again. I shall certainly keep watching it. The results from the walk forward analysis, especially using the most stable results for the fitness function, actually worked much better. And again, I shall definitely keep monitoring that version too. At the moment, that seems to be the most tradable version. And the third point is you can see by changing the exit strategy, introducing that first profitable close, we can really change the characteristics of the strategy. We've ended up taking much more trades, we've got a higher winning percentage, But of course, the profit per trade is going to be slightly lower. It's completely up to you of what kind of strategy characteristics you want, and you can adjust that by adjusting the rules. I know it's been a longer than normal video, so thanks for staying with me. Like I said, I don't normally show walk forward analysis developments because it is a much longer and a more complicated process. That being said, if you are interested, then do let me know, and I will consider putting together some videos specifically about walk forward analysis. Let me know in the comments below. Anyway, until the next video, this is Jared Goodwin, and thank you.